Hello viewers, welcome to my channel. I'm Hasham Ali Khan. Now I'm continuing the problems on income from other sources. Last video I have completed two problems on computation of income from other sources. Now third and fourth problem I'm going to explain you in this video. So before starting the video, I expect my viewers to have a printout of the problems which I have given in the link under my description. So take a printout and keep it ready before start watching this video. Take a screenshot of the solution of problems third and fourth. Then I'll explain the problems in detail. Come on viewers, see the problem number 3. Srimati Vaishnavi has submitted the following particulars of income. Calculate the income from other sources. First, winning from lottery gross 25,000. Horse race winning TDS 9,600, 22,400. Winning from lottery and winning from horse races, both are casual income and both are taxable under income from other sources, but we need the gross amount. We need the gross amount. The winning from lottery is given gross, but horse race winning is given net amount. 22,400 is given in the problem, that is a net amount after TDS of 9,600. So what we have to do? We have to add back the TDS. We want the gross amount. The gross amount is equal to net amount plus TDS. Net amount 22,400 and TDS 9,600. We add up both, right? Next, dividend from Nagarjuna Cement Company Limited 18,500. Dividend received from any company, whether Indian company or foreign company, fully taxable. So dividend from Nagarjuna Cement Company 18,500. Collection charges 30. No deduction will be allowed for collection charges. Interest paid on loan taken to purchase the shares 2,150. The Income Tax Act has given the provision. Interest paid on loan taken to purchase the shares will be allowed as deduction to the least of the following two amounts. First one, actual interest paid. Second, 20% of the dividend income. 20% of the dividend income, whichever is least, will be allowed as deduction. So we compute how much is 20% of dividend income. Next, dividend from Ford Company America, 45,000 is the net amount after TDS of 15,000. Income Tax Act says the foreign dividend will be taxable on net basis, not on gross basis. The net dividend received is 45,000. So we should take only 45,000, we should not take TDS. Then income from units of UTI. Income Tax Act has given the provision. Income from units of Unit Trust of India, fully exempted from tax. Only a note has to be given after completing the solution. After writing the answer, give a note. In that note, you write down income from units of UTI completely exempted from tax. Next, income from letting of machinery. Yes, it is income from other source. So from this income from letting of machinery, we subtract all the expenditure incurred on machinery. So what are the expenditure? Repairs on machinery, salary to operator and fire insurance premium. These three items will be deducted. Net amount is taxable. Insurance commission received 45,000, TDS 10%. Income Tax Act says insurance commission is taxable on gross basis, not on net basis. Here 45,000 rupees is given net commission because TDS is given 10%. Now we have to gross it up. So how to gross? Net commission into 100 by 90 because TDS is 10%. TDS is 10%, so we take 90. So 100 by 90. 45,000 into 100 by 90. You will get 50,000. 50,000 is the gross amount. Then family pension received. Family pension is also taxable under income from other sources. But when deduction is allowed under section 57(2)(a, the standard deduction for family pension is least of the following two. 1/3 of pension received or fixed rupees 15,000. 1/3 of pension received or 15,000 fixed. Whichever is lower, that will be deducted. Next, income from undisclosed sources. Income Tax Act says if there are any undisclosed sources income, that is also taxable under income from other sources. A refund of income tax. When there is a refund of income tax, it is not an income. It is our money which we are getting it back because we have paid excess income tax. We have paid more advance tax. So income tax department is refunding us. So our money we are getting back. So it is not an income. But if there is interest on delayed refund of tax, that is taxable. Now see here. Including interest on delayed refund of tax, 300. So this 5,600 includes 300. And what is this 300? Interest on delayed refund of tax. That is taxable. 300 rupees is taxable. That's all. So each and every point I have explained you. Now I am going to solve the problem. How the problem solution will be like this. Computation of Srimati Vaishnavi income from other sources for the assessment year 21-22. Our current assessment year 21-22. Now first I am taking dividend income. So we have dividend income. Dividend from Nagarjuna Cement Company Limited 18,500. So dividend from Nagarjuna Cement Limited 18,500. Apart from that, dividend from Ford Company America 45,000. Dividend from Ford Company America net amount 45,000. Ignore TDS because Income Tax Act says foreign dividend received is taxable only on net basis, not on gross basis. So we have taken 45,000. Take the total of the dividend income. 63,500 is the total dividend income. From this deduct. Only one deduction is allowed. Interest paid on loan taken to purchase the shares. Interest paid on loan taken to purchase the shares of Nagarjuna Cement Company. Now how much deduction? Least of the following two. Actual interest paid or 20% of dividend income. Actual interest paid is 2,150 given in the problem. And 20% of dividend. How much dividend we received from Nagarjuna Cement Company? 18,500. So 20% of 18,500, it comes to 3,700. Now find out the least of these two. 2,150 or 3,700, whichever is least. 2,150 is least. Deduct 2,150. So 63,500 minus 2,150, 61,350. 61,350 is the dividend income. These are the provisions you have to remember. Next comes casual income. Casual income means the winning from lottery gross. So winning from lottery gross amount 25,000 directly we have taken. But horse races winning net amount is given 22,400 after TDS 9,600. So TDS will be added back to get the gross amount. So we need gross winning from horse races. So 22,400 plus 9,600. 22,400 plus 9,600, 32,000. So 25,000 plus 32,000, 57,000. So two incomes we have done. One income, dividend income. Second, casual income. Now third one is income from letting of machinery. So here next page it is given. Income from letting of machinery 68,000. It is given here. 68,000. From this, deductions are allowed. Repairs to machinery 750, salary of operator 18,000, fire insurance premium 350. These are the expenditure incurred to earn the income. So it will be allowed. 19,000, the total of these three amount 19,100. Deduct 68,000 minus 19,100. 48,900 is the income from letting of plant machinery. Next comes insurance commission. Insurance commission is also taxable under income from other sources, but gross commission we require. In the problem, net commission is given. Insurance commission received 45,000, TDS 10%. After deducting tax deducted at source, 45,000. We need the gross amount. The net amount into 100 by 90. Because 10% TDS, so we multiply 100 by 90. So insurance commission TDS 10%, net commission 45,000, gross commission is equal to 45,000 into 100 by 90. It comes to 50,000. Next comes income from undisclosed sources. So income from undisclosed sources directly 84,500. No adjustment, nothing. Interest on delayed refund of tax 300 rupees. So interest on delayed refund of tax 300. Family pension received is 8,000 per month. So family pension received 8,000 per month into 12, 96,000. From this standard deduction under section 57(2)(a. Remember the section number also. 57(2)(a). List of the following two. 1/3 of pension. How much family pension received? 96,000. 1/3 of 96,000, 32,000. Or fixed amount given by the Income Tax Act. The Income Tax Act has given 15,000. Whichever is least, 15,000 is least. So 96,000 minus 15,000, 81,000 is the income. Over all the items we have taken. Now simply take the total in the last column. What is the total? 61,350 plus 57,000 plus 48,900 plus 50,000 plus 84,500 plus 300 plus 81,000. So 3,83,050. This is the income from other sources. That's all. This is the complete explanation of problem number 3. After completing this, you must give some working notes. I am not writing, but I am explaining. So always when you watch the video, keep a notebook beside you and pen. So whatever I am telling, just you keep a note. Example, income from units of UTI completely exempted from tax. So write on. Income from units of UTI completely exempted from tax. Similarly, dividend on foreign income, foreign shares, dividend on foreign company shares, it is taxable only on net amount. It will not be grossed up. That point you have to remember. Similarly, commission, insurance commission is taxable on gross basis. The amount is given net, so we have to make it gross. Income from undisclosed sources completely taxable. Like. So this is the complete explanation of problem number 3. Now I am reading out problem number 4. The following incomes are received by Mr. Ravi. Compute the income under the head income from other sources. One by one. First of all, computation of Mr. Ravi's income from other source for the assessment year 21-22. Now one by one, try to understand. Income from agricultural land in Punjab 2 lakh. Expenses on agriculture 20,000. After completing this topic of income from other sources, I am going to take up the next topic, agricultural income. In that detailed explanation I am going to give after completing this. But time being, remember one point. Agricultural income in India is fully exempted, not taxable under section 10 subsection 1. So agricultural income in India, here Punjab is given, Punjab is in India. So agricultural income in Punjab is fully exempted. After completing the solution, in note, working note, you should write down. Income from Indian agricultural income is fully exempted. Next one, income from agricultural land in Bangladesh, that means outside India. So any agricultural income earned outside India is taxable in India. So here income from agricultural land in Bangladesh 50,000 and expenses on agriculture 17,000. Deduct 17,000, 33,000 is the income. Now a question may arise. It will come in your mind. How come foreign income is taxable in India? After 2-3 chapters I am going to explain which are the incomes which are taxable, which are not taxable. For a person who is ordinarily resident in India, the income earned throughout the world is taxable in India. If the residential status is ordinarily resident in India. Anywhere in the world, if he earns the income, he has to pay the tax in India. So here also, we assume that the SSC is ordinarily resident. So income earned in Bangladesh, it is taxable in India. So first one over. Second one, director's fee from Good Luck Company Limited. Director's fees received is fully taxable under income from other source. So director's fees from Good Luck Company. Next comes rent from subletting of house 72,000, repairs of the house 5,000, municipal taxes 1,500 and rent paid for sublet portion 21,000. Previous problem also I told you, rent from subletting. Rent from subletting a house is taxable under income from other sources. Now any expenses incurred on that subletting will be allowed as deduction. So here rent received from subletting is 72,000 and expenses allowed as deduction are repairs to the house, municipal taxes and rent paid for sublet portion. So these are the expenses incurred on that house which is sublet. So take the total 27,500 deduct 44,500. Next one, rent from open land in Pune. So rent from open land is also fully taxable under income from other source. Rent from open land 16,000. Now interest income. Three different interests are given. So interest income we should take. First, 9% tax-free debentures of UP Sugar Company 50,000. This tax-free debentures of UP Sugar Company, it is called tax-free commercial security. Tax-free commercial security. For tax-free commercial security, first we have to calculate net interest. Then we have to gross up. First calculate net interest. Which type of security? Tax-free commercial security. So here it is given UP Sugar Company. It's a commercial. So first we calculate interest on tax-free debentures of UP Sugar Company. Net interest is equal to 50,000 into 9 by 100. 9% is there. The rate of interest is 9%. 50,000 into 9 by 100, 4,500. 4,500 is the net interest. Now we have to gross it up. How to gross up? Gross interest, net interest 4,500 into 100 by 90. The TDS, the tax deducted at source on interest is 10% for the current assessment year. So that's why we have to multiply 100 by 90. So 4,500 into 100 by 90, you will get 5,000. Second, 15% bonds of IDBI 3 lakh. 50% IDBI bond of rupees 3 lakh. It is not given tax free. It is given less. It is, if nothing is given, we assume it is less tax. It is less tax. So directly we have to calculate. Directly we will get the gross interest. The gross interest is equal to face value into rate by 100. What is the face value of the bonds? 3 lakh. And what is the rate of interest? 15%. So 15 by 100. 3 lakh into 15 by 100, 45,000. What is the difference between this first interest and second interest? First interest, it is given tax-free commercial security. So first calculate net interest, second calculate gross interest. Whereas in case of IDBI bonds, it is not given tax-free. So it is called less tax. Where it is less tax, directly we will get the gross interest. We should not calculate net interest and gross interest. Directly gross interest. Face value into rate by 100. The face value 3 lakh, rate 15. So 45,000. Last one is interest received from debentures of X Company Limited 18,000. Interest received is given. When the interest received is given, it means it is the net interest. Whenever the word received is given, you should think it is a net interest. So this 18,000 rupees is the net interest received. Now we have to gross it up. How to gross it up? Multiply 100 by 90. So 18,000 into 100 by 90, you will get 20,000. So 3 interest ho gaya. First one, interest on tax-free debentures of UP government UP Sugar Company. So first calculate net interest, then gross, because it is tax-free and commercial. Secondly, tax-free not given, IDBI bonds are given. Directly we calculate gross interest. Thirdly, interest received is given. Whenever received is given, it is called net interest. The interest given is the net interest. Now we have to gross up. So 100 by 90, 20. So take the total 70,000 rupees is the interest income. Next one. Dividend on preference shares 13,000, fully taxable. So dividend on preference shares 13,000, directly taken. Honorarium for delivering lecture 69,000 and expenses incurred 15,000. Honorarium received for giving the lectures. So this honorarium received is also taxable under income from other sources, and any expenditure incurred in order to earn the income should be deducted. So 15,000 rupees deducted, 54,000 rupees is the taxable honorarium. That's all the points I have taken. Now simply take the total: 33,000 plus 1,80,000 plus 44,500 plus 16,000 plus 70,000 plus 13,000 plus 54,000. 4,10,500. 4,10,500 is the income from other sources. That's all. This is the end of problem number 4. In examination, not only you should make this computation, but also you have to give the notes, working notes. In the working note, you should write on, first of all, income from agricultural land in India is fully exempted from tax. First note. Then second note, agricultural income from a foreign country is fully taxable in India. Third one, directors fee, subletting, all these things you know. Next, tax-free commercial security. First net interest, then gross interest. Whereas 15% bonds of IDBI, directly we calculate gross interest. And when interest received is given, it is the net interest, we have to gross down, right? And dividend on preference shares fully taxable, honorarium fully taxable. That's all. So this is the end of problem number 4. Totally 4 problems I have completed. Last video 2 problems, this video 2 problems. 4 problems I have explained in detail about this computation of income from other sources. So if you are satisfied with my lecture, give a like to the video, share my channel in your group, in your friend circle, so that more students can watch the video and enhance the knowledge. And one more channel I have started by name Khan's Accounting Institute. Khan's Accounting Institute. This second channel I have prepared for IGCSE students. So if any of you are from IGCSE pursuing IGCSE courses, then please go to the second channel by name Khan's Accounting Institute. Subscribe that channel, watch the videos. Definitely you will get a lot of knowledge from these videos. Inshallah, we'll continue the next problem in the next video.